Hey everyone, and welcome back to Talk Tickers. Today we are diving into the world of Krispy Kreme, those delicious donuts. And we're going to be breaking down their latest earnings call, sifting through all those financial crumbs, to see what's really cooking behind the scenes. And of course, we wouldn't leave you hanging without our signature It's Not Financial Advice segment, where we'll try to cook up a trade idea based on what we've learned.
Sounds like a plan. Always interesting, to see how these iconic brands like Krispy Kreme are navigating this ever-changing, food industry landscape.
Yeah, for sure. And to get our sugar fix today, we are digging into their Q3 2024 earnings call transcript and checking out, some of the usual key stock data from those reputable financial sites.
We'll do our best to cut through all that jargon and then give you the insights that you need, whether you're a seasoned investor or just kind of curious about the business world.
Yeah, exactly. All right, so let's jump right into the dough, or should I say the news that has everyone buzzing. Krispy Kreme's nationwide rollout with McDonald's. Remember those early tests in Kentucky and Chicago?
Mm-hmm.
Well, they are going full steam ahead, expanding into states like Ohio, Indiana, Pennsylvania, and West Virginia just this month.
Yeah, it's a pretty bold move for sure. I mean, they're aiming to be in nearly 2,000 McDonald's locations by the end of 2024 and a whopping 12,000 by 2026. Talk about aiming for a bigger bite of that breakfast market.
Totally. And what's so fascinating is they're doing this without the cost of building new stores. They're really leveraging their existing production capacity and reaching just like a massive audience through McDonald's.
It's like a match made in fast food heaven. From a strategic standpoint, this partnership really makes a lot of sense for both companies. McDonald's gets to offer a beloved brand and a sweet treat that complements their menu. And then on the other hand, Krispy Kreme, they get access to McDonald's incredible distribution network and their, very loyal customer base.
And it's not just about grabbing those impulse buyers at the drive-thru. McDonald's is putting some serious marketing muscle behind this rollout. We're talking TV ads, billboards, you name it.
Oh, yeah. It's like a free marketing blitz for Krispy Kreme. And those early reports from the test markets, they're very encouraging. Consumers seem to be loving the convenience of, grabbing a Krispy Kreme donut with their, morning coffee.
Or their Egg McMuffin.
Exactly. Now, while the McDonald's deal is grabbing all the headlines, Krispy Kreme isn't putting all their glazed donuts in one basket. They're also expanding their delivered fresh daily program, or DFD for short, with other retail giants like Target and Walmart.
DFD.
Mm-hmm.
That's a brilliant strategy, in my opinion. It allows them to capitalize on those existing production hubs and increase their points of access without the overhead of building new stores.
Yeah, and they're even testing DFD deliveries to Costco warehouses in Southern California. Can you imagine walking into a Costco and just being greeted by a tower of Krispy Kreme donuts? Talk about impulse buys. Smart move to target that Costco membership base, known for their, brand loyalty and their, shall we say, enthusiasm for bulk purchases.
Okay, so things seem pretty sweet on the home front. But what about internationally? It seems like Krispy Kreme is experiencing a mixed bag of results across the globe.
Yeah, that's right. They're seeing strong growth in markets like Canada, Japan, and Australia, but they've hit a bit of a snag in the UK.
What is it about the UK that's proving to be so tough to crack?
Well, the UK market is facing some unique challenges, from evolving consumer trends to some regulatory changes in the food industry. Plus, there's always the factor of local competition and adapting to, different cultural preferences.
Makes sense.
Yeah, what flies in the US might not be a slam dunk across the pond.
Exact.
Krispy Kreme has acknowledged that they need to make some strategic adjustments in the UK, and they've even, brought in a new management team to kind of tackle these issues.
Okay, so we've talked about the big strategic moves. Now let's get into the nitty-gritty. The financials. First up, revenue. Krispy Kreme reported 3.5% organic revenue growth for Q3. Not too shabby, especially considering this marks their 17th consecutive quarter of growth.
17 quarters in a row. That's impressive consistency, especially in today's, volatile market.
Yeah, it really is. And their DFD program and digital sales are definitely fueling this growth. But there's a bit of a twist in the tail when it comes to their adjusted EBITDA.
Ah, yes. The adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a key metric that investors use to assess a company's profitability.
Right, and for Krispy Kreme, their adjusted EBITDA actually declined in Q3, primarily due to the sale of Insomnia Cookies.
That sale was a strategic move, to streamline their core business and focus on those donuts, While it impacts the EBITDA in the short term, it allows them to allocate resources to high-growth areas like, you guessed it, the McDonald's partnership and DFD expansion.
So it's a bit of a trade-off, right? Short-term pain for potential long-term gain.
Exactly. But there are a couple of other factors that kind of put a dent in those profit margins. Increased vehicle accident claims, and the good old summer seasonality.
Wait, vehicle accident claims, how does that affect their donuts?
Well, remember all those DFD deliveries we talked about? Managing a large fleet of delivery vehicles comes with its own set of risks. And unfortunately, Krispy Kreme experienced a higher than usual number of accidents this quarter, leading to increased insurance costs.
Ah, that makes sense. And what about the summer seasonality? Are people just not craving donuts when it's hot outside?
It's not that people don't love donuts in the summer. Q3 is typically their slowest quarter for a few reasons. People tend to be more health conscious during the summer months, opting for lighter fare, plus there's increased competition from seasonal treats like ice cream and popsicles.
There's a combination of factors impacting those margins.
Uh-huh.
All right, before we move on, let's just sprinkle in a few more financial details that might be helpful for our listeners.
Sounds good. Let's break down those numbers and see what they reveal about Krispy Kreme's, overall financial health. Okay, so let's take a closer look at some key metrics that really stood out to me. First off, their DFD program is rocking. An average revenue per door per week of $592. That's pretty impressive considering the variety of customers and products they're delivering to places like convenience stores, grocery chains, and even those Costco test runs.
Wow, $592 a week. That's a whole lot of donuts. Seems like this DFD program is really living up to its name, delivering those fresh donuts and, more importantly, those fresh profits.
Exactly. But it's not all sunshine and sprinkles, On the flip side, their U.S. adjusted EBITDA margin took a 6.1% dip, primarily due to those pesky vehicle accident claims we mentioned earlier. Goes to show that even with a well-executed strategy, unexpected events can really throw a wrench into the works.
It's a reminder that every business, no matter how successful, faces its own set of challenges and risks. But hey, that's what makes analyzing these earnings calls so interesting. It's like a real-life business thriller with plot twists and unexpected turns.
Yeah, I like that analogy. Speaking of twists and turns, let's take a quick detour to their international performance. Their equity-owned markets showed a 4.2% organic revenue growth, which is a decent clip, Canada, Japan, and Australia are leading the charge. But as we discussed, the UK is still a bit of a soft spot.
Yeah, it seems like they're still working on finding that right recipe for success in the UK. But let's focus on the positives for a moment. Their market development segment, which focuses on those franchise partnerships, is seeing some pretty impressive growth, an 8.6% increase, in fact. And they're boasting a robust adjusted EBITDA margin of 54.2% in that segment.
That's a testament to the efficiency and profitability of their franchise model, especially in new and emerging markets. They're leveraging local expertise, minimizing their upfront investment, and reaping the rewards of rapid expansion without taking on,
all the risk themselves.
It's like they're saying, hey, we got this amazing donut concept, and we're happy to share the recipe for success with you. Exactly. And it's proving to be a winning formula, especially in markets like Morocco, which they recently entered. It's exciting to see Krispy Kreme, expanding its global footprint and bringing those melt-in-your-mouth donuts to new corners of the world.
Okay, so we've covered a lot of ground, from strategic partnerships to international expansion, to those all-important financial figures. But before we move on to our This Is Not Financial Advice segment, I'm curious from your perspective. As a seasoned financial analyst, what's the biggest takeaway for our listeners? Who might be considering investing in Krispy Kreme?
That's a great question. I think the key takeaway here is that while there are some near-term challenges, particularly with those profit margins, Krispy Kreme's overall growth story remains intact. The McDonald's partnership and the broader DFD expansion have the potential to be significant growth drivers in the long run. It's a classic case of weighing the potential risks and rewards.
So it's all about balancing those short-term bumps in the road with the potential for long-term gains. Sounds like a classic investment dilemma. Speaking of dilemmas, are you ready to dive into our This Is Not Financial Advice segment and whip up a potentially outrageous yet plausible trade idea based on everything we've learned about Krispy Kreme?
Bring it on. Remember, folks, this is purely hypothetical and for entertainment purposes only. We are not financial advisors. Do your own research, assess your risk tolerance, and all that jazz.
Couldn't have said it better myself.
Yeah.
Okay, so given the McDonald's rollout and the potential for it to be a smashing success, I'm thinking, why not buy Krispy Kreme call options with a long expiration date? It's a bet on their long-term growth, especially if this partnership delivers as promised.
That's a bold move. It's like saying, I'm betting on Krispy Kreme. To hit the jackpot with McDonald's and ride that wave of success, the potential reward could be substantial if their stock price takes off. But as with any options trade, there's inherent risk.
Right. It's like those delicious glazed donuts. Tempting and potentially rewarding, but with the potential for a sticky mess if things don't go as planned.
Exactly. The stock price could stagnate. Or worse, decline. And you could lose your entire investment. Remember those near-term margin pressures we discussed? Those startup costs associated with the McDonald's expansion could weigh on earnings in the short term, potentially impacting the stock price.
So it's a high-risk, high-reward scenario.
Yeah.
Just like that extra donut you sneak. After promising yourself you'll stick to just one.
Precisely. But hey, that's what makes the market so exciting, right? It's all about weighing those risks and rewards and making informed decisions based on your own individual circumstances.
Absolutely. And speaking of informed decisions, let's move on from our "this is not financial advice" detour and dig a little deeper into some specific aspects of Krispy Kreme's growth strategy.
Sounds good to me. Let's start by examining the potential long-term impact of this McDonald's partnership on Krispy Kreme's brand awareness and future growth. After all, aligning yourself with a global fast food giant like McDonald's is no small feat.
Yeah, it's like they've just secured prime real estate in the minds of millions of potential donut lovers. But can they capitalize on this opportunity and transform those curious first-time buyers
Into loyal Krispy Kreme fans? That's the million-dollar question.
That's the question that we'll try to answer as we continue to analyze their progress and see how this partnership unfolds. It's a fascinating case study in brand collaboration and, the evolving dynamics of the food industry.
It really is. Okay, so let's put on our marketing hats for a moment and analyze how this partnership could reshape Krispy Kreme's brand image and reach those coveted new customer demographics. Think about it. McDonald's is a master of brand recognition. That Golden Arches logo is instantly recognizable around the world. By partnering with them, Krispy Kreme is essentially tapping into that existing brand equity and exposing themselves to a whole new audience, many of whom might have never even considered trying a Krispy Kreme donut before.
It's like they're borrowing a bit of that McDonald's magic, sprinkling it on their donuts and hoping it rubs up on their brand.
Exactly. And it's not just about attracting new customers. This partnership also reinforces Krispy Kreme's existing brand image. By aligning themselves with a well-established, trusted name like McDonald's, they're sending a signal to consumers that they, too, are a brand that represents, quality, consistency, and value.
Plus, let's not forget the operational expertise that McDonald's brings to the table. They're renowned for their efficiency and their ability to scale operations seamlessly. I wouldn't be surprised if Krispy Kreme learns a thing or two from this partnership that could further optimize their own production distribution and even their customer service.
That's a great point. There's a lot of potential for valuable knowledge transfer between these two companies. Krispy Kreme could benefit from McDonald's insights into supply chain management, quality control, and even marketing strategies tailored to different demographics. It's a win-win situation.
Okay, so we've covered the McDonald's excitement, but let's loop back to the DFD program and its role in Krispy Kreme's overall growth strategy. Remember, it's not just about those golden arches. They're expanding their reach through partnerships with a variety of retailers.
Yeah, the DFD program is a key element of their hub-and-spoke model, which focuses on maximizing production efficiency and reaching a wider customer base. By strategically placing production hubs and distributing those fresh donuts daily to various retail partners, they're able to leverage their existing infrastructure and expand rapidly without the significant capital investment required to build new stores.
It's like they're creating a donut delivery network, ensuring those fresh, melt-in-your-mouth donuts are available wherever and whenever people crave them. And they've got some serious momentum in the U.S. with DFD. We've talked about Target and Walmart, and now they're even testing the waters with Costco.
That Costco partnership is intriguing. Costco customers are known for their brand loyalty and their willingness to spend, especially on food items. If Krispy Kreme can successfully tap into that market, it could be a game changer for their revenue. Imagine those bulk-sized boxes of Krispy Kreme donuts flying off the shelves.
It's a brilliant move to target those Costco shoppers who are already in the mindset of stocking up on their favorite treats. Yeah. And it plays perfectly into Krispy Kreme's strategy of increasing their points of access. They're aiming for a whopping 15,000 points of access in the U.S. by the end of 2026. That's a lot of donuts.
It is, but the key is to ensure that this expansion is profitable. They need to carefully manage logistics, optimize those delivery routes, and maintain consistent product quality across all those locations.
Right. It's one thing to have those donuts available everywhere, but they need to taste just as good, whether you're buying them at a convenience store, a grocery chain, or a Costco warehouse.
Yeah,
Consistency is key.
absolutely. And let's not forget those vehicle accident claims, which serve as a reminder that even logistics can be a challenge.
Yeah, it's like they say, it's all fun and games until someone spills a truckload of donuts.
Let's have to remember that one. But seriously, managing a large-scale delivery operation is no easy feat. It requires careful planning, risk assessment, and constant monitoring to ensure that those donuts arrive at their destinations safely and on time.
Speaking of challenges, let's revisit the UK market for a moment. We know they're facing some headwinds there, and they've brought in a new management team to address the underperformance. What specific steps are they taking to turn things around?
From the earnings call, it sounds like they're taking a multi-pronged approach. First, they're reassessing their product mix. Apparently, the iconic original glazed donut, which is their bread and butter in many markets, has a lower proportion of sales in the UK compared to other regions. So they're looking to adjust the menu to better align with local preferences. Maybe the Brits prefer a different type of glaze, or perhaps they're more into cake donuts than yeast donuts.
It's fascinating how consumer tastes can vary so much across different regions. What's considered a classic in one country might be a flop in another.
Absolutely. And another area they're tackling is value perception. They're experimenting with different price points for various product ranges, trying to find that sweet spot that resonates with UK consumers. Maybe they need to adjust their pricing strategy to better compete with local bakeries, or offer more value-oriented bundles to entice those budget-conscious Brits.
It sounds like they're taking a data-driven approach, analyzing consumer trends, testing different strategies, and seeing what sticks.
Exactly. They're not just throwing donuts at the wall and hoping something sticks. They're being strategic and using data to inform their decisions. They're also emphasizing the importance of operational excellence, ensuring that the quality and service are consistent across all locations.
So it's about fine-tuning their offerings, refining their pricing, and ensuring that every customer has a positive experience.
Precisely. They're addressing those market-specific challenges head-on and hoping to turn the tide in the UK. Only time will tell if their efforts will bear fruit.
It'll be interesting to watch their progress in the coming quarters. Now let's zoom out a bit and consider Krispy Kreme's broader international expansion strategy. They're placing a heavy emphasis on the franchise model, particularly in new and emerging markets. It seems like a smart move to leverage local expertise and minimize their upfront investment.
Yeah, the franchise model is a classic strategy for rapid international expansion. And it makes perfect sense for a company like Krispy Kreme that's still in growth mode. It allows them to expand their footprint quickly and efficiently with lower capital investment. Think of it like planting donut seeds around the world and watching them grow.
I love that analogy. And by partnering with local franchisees, they're tapping into valuable on-the-ground knowledge. Those franchisees often have a better understanding of local consumer preferences, market dynamics, and even regulatory nuances. It's like having a team of donut ambassadors in each country.
That's a great way to put it. They're not just exporting donuts, they're exporting a proven business model and empowering local entrepreneurs to bring those delicious treats to their communities.
But hold on. While the franchise model can be highly effective, aren't there also potential challenges? What's to stop those franchisees from messing things up? I mean, what if they don't make those donuts just right? Or the customer service is terrible? That could hurt the whole Krispy Kreme brand, right?
Yeah.
You're raising a valid concern. Maintaining brand consistency and quality control across a vast network of independently operated franchises can be a real challenge. Krispy Kreme needs to have robust training programs, clear brand guidelines, and effective quality assurance measures in place to ensure that every Krispy Kreme location, whether company-owned or franchised, delivers a consistent customer experience.
So it's like a delicate dance between empowering those local franchisees while also ensuring they adhere to the Krispy Kreme standards.
Exactly. They need to find that balance between local adaptation and brand consistency. It's a challenge that many global brands face as they expand internationally. And while the franchise model offers many advantages, it also comes with its own set of complexities.
It's a reminder that growth and expansion are not always easy. It requires careful planning, strategic decision-making, and a bit of good old-fashioned donut magic.
Couldn't agree more. It's an exciting journey to watch. And we'll be here to analyze every twist and turn along the way.
All right, so we've covered a lot of ground in this deep dive, from strategic partnerships and international expansion to financial performance and those all-important profit margins. But before we wrap things up, let's take a moment to zoom in on one specific aspect of Krispy Kreme's financials that has sparked some concern among investors: those declining profit margins. After all, even the sweetest of donuts can leave a bitter taste if the numbers aren't adding up.
It's true, those declining margins have raised some eyebrows, in the investment community. After all, a 9.1% adjusted EBITDA margin for Q3 isn't exactly something to celebrate, especially when you consider this is a company experiencing its 17th consecutive quarter of growth on the surface. It seems a bit counterintuitive.
It does make you wonder, right? If their revenue is growing steadily, shouldn't their profits be following suit? What's the disconnect here?
Well, as with most things in the business world, it's rarely a simple answer. There are a few factors at play here. First off, as we've discussed, the sale of Insomnia Cookies, while strategically sound, created a short-term hit to their EBITDA. They essentially traded a chunk of their earnings for the opportunity to focus on their core donut business and pursue high-growth initiatives like the McDonald's partnership.
So it's like they took a temporary step back to hopefully take 2 steps forward in the future.
Exactly. And let's not forget, those pesky vehicle accident claims, those unplanned expenses definitely put a dent in their profit margins this quarter. It's a reminder that even the best laid plans can be disrupted by unexpected events.
Yeah, those accidents were a real curveball. And then there's the summer seasonality factor. Q3 is typically their slowest quarter, which can make it harder to absorb those fixed costs and maintain healthy margins. It's like trying to sell hot chocolate in the middle of the heat wave.
That's a great analogy, but the good news is that they're anticipating a much stronger performance during the upcoming holiday season, which is traditionally their busiest time of year. Plus, they're implementing some cost-cutting measures and restructuring efforts to streamline their operations and reduce those SG&A expenses. Those pesky selling general and administrative costs that can eat into profits.
So it's a combination of temporary factors and proactive measures they're taking to address those margin concerns. But I think the bigger question on investors' minds is whether this aggressive growth strategy, particularly with the McDonald's rollout, can be sustained profitably in the long run.
That's the million-dollar question, isn't it? They're projecting significant long-term revenue and EBITDA growth from these partnerships. But that initial ramp-up phase will likely involve substantial investments and potentially some continued margin pressure. It's like they're building a rocket ship to launch their brand into a new orbit, but those rocket engines require a lot of fuel, and fuel costs money.
That's a great way to visualize it. So they're essentially betting that those initial investments will pay off in the long run, leading to higher profits and a stronger market position. It's a classic high-growth strategy, but it comes with its own set of risks and rewards.
Exactly. They're walking a tightrope between aggressive expansion and maintaining profitability.
Yeah.
They need to strike that delicate balance to keep investors happy and ensure their long-term success, and that's where execution becomes paramount. They've laid out an ambitious plan, but their ability to execute effectively will determine whether they reach those lofty goals.
So it all comes down to their ability to navigate those challenges, optimize their operations, and deliver on those promises of future growth and profitability. Investors will be watching closely to see if they can pull it off.
Absolutely. It's a fascinating case study in the complexities of growth management, strategic partnerships, and navigating those ever-changing market dynamics.
Well said. And with that, I think it's time to indulge in our favorite segment, This Is Not Financial Advice, where we throw caution to the wind and brainstorm a fun, outrageous, but plausible trade idea based on all this Krispy Kreme goodness.
Bring on the speculative shenanigans, but before we get too carried away, remember, folks, this is purely hypothetical and for entertainment purposes only. We are not financial advisors, and any investment decision should be based on your own research, risk tolerance, and financial circumstances.
Couldn't agree more. Always do your due diligence and consult with a qualified professional before making any investment decisions. Now, with those disclaimers out of the way, let's get creative, given Krispy Kreme's heavy focus on international expansion, particularly through franchises. How about we consider investing in a publicly traded coffee chain that's also experiencing rapid growth through franchising in similar markets?
Ooh, I like where you're going with this. It's a play on the global coffee and snacking trend, but without the direct exposure to Krispy Kreme's near-term margin pressures. It's like betting on the rising tide that lifts all boats in the harbor. Exactly. We're not picking winners and losers. We're just recognizing a broader trend and trying to find a company that's well-positioned to benefit from it. Of course, this is highly speculative, And there's no guarantee that the coffee chain will succeed. Every investment comes with its own set of risks.
Precisely. But that's what makes it fun, right? It's about thinking outside the box, connecting the dots, and exploring those what-if scenarios.
Absolutely. It's all about sparking those creative juices and encouraging our listeners to think critically about the market. So there you have it, folks. This is not financial advice trade idea, a speculative play on the global coffee and snacking trend inspired by Krispy Kreme's international ambitions.
And remember, this is just a thought-provoking idea to get you thinking, not a recommendation to rush out and buy coffee stocks. Always do your own research and make informed decisions based on your individual circumstances. Well said. Okay, listeners, as we wrap up this deep dive into Krispy Kreme's latest earnings call, here are the key takeaways. Krispy Kreme is on a mission to become bigger and better with ambitious expansion plans both in the U.S. and internationally. That McDonald's partnership has the potential to be a game changer, but there are also challenges to overcome, particularly with those declining profit margins.
The coming quarters will be crucial for Krispy Kreme as they navigate these growth opportunities and address those margin concerns. Investors will be watching closely to see if they can deliver on their promises. It's a fascinating story of ambition, innovation, and the ever-evolving dynamics of the food industry.
It really is. And remember, while we had some fun with our This Is Not Financial Advice segment, always do your own research before making any investment decisions. We're just here to provide you with insights and a fresh perspective on the business world.
Exactly. We're here to entertain, inform, and hopefully spark some interesting conversations.
So until next time, keep those brains glazing, those portfolios hot. This is Talk Tickers signing off.